Imagine a company generating so much cash that it's literally bought back and retired over a third of its entire outstanding share count in under 3 years. Think about that for a second. Over a third of the company just bought back and retired. You would think the market would be aggressively rewarding that kind of absolute masterclass in capital return, right? Instead, this company is trading at a deeply distressed forward price-to-earnings multiple of roughly 5.6x. So what does this all mean? Well, it means the market is either completely wildly mispricing the stock, or investors are absolutely terrified of a hidden risk lurking just under the hood. Today, we're breaking down General Motors and figuring out exactly what the market is getting wrong or right. I want to start right here with this stark number, a 5x forward PE multiple. To put that into perspective, that is the kind of valuation usually reserved for businesses in terminal decline. But coming right off their latest financial results reported on July 21, 2026, General Motors actually showed incredibly resilient record-level profitability in their core operations. The cash is flowing. Yet, Wall Street is pricing this business like a melting ice cube. To truly understand this massive valuation gap, we need to completely separate how GM actually makes its money today from what it is quietly building for tomorrow. Let's pull the business apart into two distinct pieces. First, you have the traditional hardware business. This is the GM you already know. We're talking internal combustion engines, cyclical wholesale volumes, selling directly to independent dealers, and heavy capital expenditures. It's an absolute cash cow, heavily driven by light-duty pickup trucks and SUVs in North America. But then, on the right side, you have the reality of where they are actively pivoting, the software-defined vehicle. This isn't just about selling a car and walking away anymore. We're talking high-margin, recurring subscriptions, the Super Cruise hands-free highway driving ecosystem, and a massive $6.3 billion deferred digital backlog. This transition from a cyclical, heavy metal hardware manufacturer to a highly predictable, software-defined ecosystem is the real story here. And frankly, this pivot is completely non-negotiable. Standard automotive assembly? It's a globally mature market. Volume growth is fundamentally constrained by population and macro factors. But the high-growth opportunity? That sits squarely in automotive software. Look at this total addressable market. It's projected to exceed $108 billion by 2033, compounding annually at an incredible 13 to 16%. And notice that slice right there? Advanced Driver Assistance Systems, or ADAS, along with safety software, makes up 34% of this total pie. This is exactly where GM is targeting its recurring revenue via its OnStar connected intelligence platform and Super Cruise. They are positioning themselves to capture a highly lucrative recurring revenue stream that standard legacy automakers have completely missed. Now, you might be wondering, how does a legacy automaker actually fund this kind of massive, capital-intensive software ambition without going bankrupt? Well, they do it through a surprisingly entrenched economic moat built on 4 core pillars. First, they have immense structural scale cost advantages driven by incredibly high assembly plant utilization. Second, unmatched full-size truck brand equity. Customers are fiercely loyal to the Chevy Silverado and GMC Sierra. That loyalty creates a persistent pricing umbrella. They can charge a premium and people will pay it. Third, we have proprietary ecosystem switching costs. Once a family gets used to the convenience of Super Cruise on a long road trip, they literally don't want to drive anything else. And fourth, they have a captive financing shield via GM Financial, which stabilizes retail penetration and crucially helps them manage residual vehicle risks. So let's zoom out and look at the competitive landscape, because GM isn't operating in a vacuum. Against Ford, their most direct domestic rival in the highly profitable truck space, GM has actually been outperforming lately. They've delivered far more consistent North American operating margins by using a highly disciplined approach to inventory, basically not flooding dealer lots just to hit volume metrics. Then you have Toyota, posing a massive hybrid market share threat. GM's response? They are using their sheer combustion core dominance in North America to violently defend their home turf. And finally, against the vertically integrated brutal EV pricing pressure from Tesla and BYD, GM actually made a genius strategic shift. They abandoned their hard volumetric EV goals. Instead of bleeding billions trying to outproduce Tesla, they are right-sizing their electric capacity to match actual organic consumer demand, strictly containing their structural EV losses. Okay, so if the core combustion business is printing cash, and they are smartly containing their EV losses while rapidly building a high-margin software backlog, what is the market so terrified of? Why the 5x PE? This brings us to the central conflict. The bear case is entirely driven by fear of a peak auto cycle contraction. The market is terrified that the legacy gas-powered cash engine is about to completely stall out. They fear the crushing, potentially endless capital costs of a messy EV transition. And on a macro level, they are deeply worried that higher for longer interest rates are going to squeeze the everyday consumer, forcing retail car loan delinquencies through the roof and crushing demand. That bear case sounds perfectly logical, right? But the hard evidence aggressively challenges that doom and gloom narrative. Let's look at the numbers from their July 21, 2026 quarterly results. Look at this Q2 adjusted EPS beat. Wall Street's consensus was sitting around $3.13 to $3.19. GM actually came in and reported $3.57. They didn't just beat expectations, they completely shattered them. Total net sales reached a staggering $48 billion, generating the first year-over-year revenue expansion the company has seen since Q1 of 2025. And this was driven entirely by their North American segment, where adjusted EBIT margins climbed right back up into their target Goldilocks range of 8 to 10%. And they didn't just have a good quarter in the rearview mirror. On the back of those incredibly strong first-half operating trends, management did something you very rarely see from a supposedly dying legacy business. They raised guidance across the board. For the second time this year, adjusted EBIT is now projected to hit up to $16 billion. Auto free cash flow was raised to a high end of $11.5 billion, and adjusted EPS was bumped up to an impressive $12 to $14 range. They are literally telling the market, we are making more money than you think we can. And by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed. Now, I have to address the elephant in the room. If you only read the financial headlines for Q2, you probably saw a scary number. GAAP net income actually declined by 31%. But here is the absolutely critical context that the headline scanners missed. That drop was largely driven by a non-recurring, one-time $2.3 billion EV strategic realignment charge. Essentially, management is aggressively absorbing the pain of right-sizing their electric vehicle production footprint today. By ripping the Band-Aid off and taking this massive charge right now, they are actively containing future cash burns and protecting the long-term structural margins of the entire business going forward. And while they clean up the EV side of the house, the software side is just quietly exploding in the background. During the earnings call, management noted something massive. Their deferred software revenue backlogs grew nearly 50% year-over-year to $6.3 billion. And they expect this backlog to hit $7.5 billion by year-end. Why does this matter? Because this is highly predictable, recurring monthly cash flow coming in at roughly 70% gross margins. Let that sink in. 70% margins. This provides a massive baseline for future valuation expansion, fundamentally pulling GM away from those low single-digit standard auto multiples and changing them closer to actual technology multiples. So when we synthesize all of this qualitative analysis into a business scorecard, we land on a blended score of 7.2 out of 10. And the absolute standout here? Capital allocation, sitting at a phenomenal 9 out of 10. The board has retired over 35% of outstanding shares since late 2023 through a brilliant $23 billion share buyback program. But, and this is a very big but, we have to look at management alignment, which sits at a highly concerning 4 out of 10. We are seeing persistent, large, open market stock sales from CEO Mary Barra and the broader executive suite, paired with really disappointing shareholder proxy support on executive compensation. It's a glaring red flag in an otherwise strong setup, and you absolutely must watch it. Quick pause here. All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is completely free. Now, if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, before we dive into the 5-year scenario framework, I need to state this clearly. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. To figure out where this stock could realistically be in 5 years, we have to walk through the actual operational math. In our base case scenario, we're assuming a very modest 2% revenue compound annual growth rate. We assume a 5.5% net margin as their software division scales up. We also assume they continue aggressive buybacks, lowering the total share count to roughly 0.68 billion, and we assign a slightly improved exit multiple of 7x. Now, in the high case, rapid Super Cruise adoption and highly profitable EV segments drive a 4.5% revenue compound annual growth rate, expanding margins to 6.5% and expanding that multiple to 9x PE. But we have to look at the low case. Here, prolonged macroeconomic downturns and margin contractions shrink revenue by 1% annually, slash margins to 3.5%, completely halt the buybacks, and compress that exit multiple to just 5x. When we run that operational math forward, it reveals a truly fascinating, highly asymmetrical setup. The low case, which we assign a 20% probability, implies a future price of $38.69. The base case, sitting at a 55% probability, hits $116.27. And that high case, at a 25% probability, targets an incredible $226 per share. When you take those scenarios and probability weight the outcomes, you get a weighted target of $128.19. That implies a potential upside of over 60% from post-earnings levels. It proves mathematically that if management simply executes on their current stated trajectory, the risk-reward profile is heavily tilted in the investor's favor. However, we have to respect the concrete risks that could totally break this thesis. The nearest execution threat is the plant retooling scheduled for late 2026 to launch their next-generation V8 trucks. If that downtime extends longer than planned, it compresses their seasonal cash flow immediately. On the financial side, you need to watch retail delinquencies over at GM Financial. If annualized net charge-offs spike past the 1.75% mark, or worse, if wholesale used car auction values suddenly crash, it could trigger severe structural write-downs on GM Financial's massive $32.9 billion lease portfolio. That would be devastating to the bottom line. So let's recap the intellectual journey we just took. We started with the mystery of a highly profitable company trading at a severely distressed 5x PE ratio. And we found three core takeaways. First, their deeply entrenched, highly profitable combustion truck business is successfully funding a capital-light, high-margin transition into software. Second, they're weaponizing all that excess cash flow into record share retirements, aggressively forcing earnings per share to accrete. And third, despite legitimate microeconomic headwinds and real execution risks, that massive valuation gap simply offers a fundamentally asymmetrical setup. Ultimately, the market is pricing General Motors for a collapse that the underlying financial execution simply doesn't show. Instead of a melting ice cube, what we are really looking at is a cash flow machine that is priced for unlock. The tension between that 5x multiple and their massive share buybacks can't last forever. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.sentinel.ai. So, is GM the ultimate value trap or the greatest legacy turnaround play of the decade? Do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.